If you were born before 1965, I need you to stop what you're doing right now, because what I'm about to share could be worth thousands of dollars to you. Not someday, not when you pass away, right now, while you're still collecting benefits and trying to make ends meet each month. Here's the thing most retirees never think about. At some point in your life, maybe decades ago, you made decisions about your retirement. You filled out forms. You named people on your accounts. You had wages reported to the Social Security Administration. And then life moved on. You trusted that everything was handled correctly. You assumed those old records were fine. You never looked back. But what if one small detail, something you filled out in 1987, or a number your employer reported incorrectly in 2001, or a form you signed after a marriage or divorce, what if that one overlooked detail has quietly been costing you money every single month? What if the retirement you built over 35 years of hard work is quietly being shortchanged because of something nobody ever told you to go back and check? Today, we are going to fix that. Stay with me. Let's start with something that shocks most people the first time they hear it. Your Social Security benefit, the monthly check you receive, or the one you are counting on, is not calculated from a general ledger somewhere. It is not simply based on the number of years you worked. It is based on the actual earnings numbers that were reported in your name, year by year, going all the way back to your very first job. The Social Security Administration keeps what is called an earnings record. It is essentially a list of every year you worked and every dollar that was officially reported as your income. When the time comes to calculate your benefit, SSA takes your 35 highest earning years from that record and uses them to determine your monthly payment. Here is where the problem begins. That earnings record was built over decades, often 40 or 45 years of working life. During that time, you may have changed jobs a dozen times. You might have had employers who made reporting mistakes. You may have worked for a small business that did paperwork incorrectly. You might have changed your name after a marriage or divorce. You might have worked multiple part-time jobs where one or two slipped through the cracks. You might have been self-employed for a few years and filed taxes slightly differently. Any one of these situations can result in earnings that were simply never credited to your record. And here is what makes this so dangerous. You cannot see the damage if you never look. These errors sit quietly on your record, invisible to you, reducing your benefit calculation year after year, and most retirees never know it is happening. The numbers are serious. If just 1 year of your earnings was reported at $38,000 when you actually earned $54,000, a $16,000 difference, that single-year error can reduce your monthly benefit by roughly $80 to $100 every month. That is $1,000 a year. Over a 20-year retirement, that one uncorrected mistake cost you $20,000. And that is just 1 year. Imagine 2 wrong years, or 3, or 5. Research has found that the Social Security Administration holds over $2 trillion in unmatched wages, money that was earned by real people, reported by real employers, but never successfully linked to the right Social Security record. Some of that money may belong to you. Now you might be thinking, I've been receiving Social Security for years. Isn't it too late? Not necessarily. If you have not yet claimed, there may still be time to correct your record and receive a higher benefit going forward. And even if you are already receiving payments, understanding whether your starting benefit was calculated correctly matters enormously, because that original calculation determines every cost of living increase you receive from that point forward. A lower base number means smaller raises every single year for the rest of your life. There is a simple tool available at ssa.gov called My Social Security. Once you create a free account, you can view your full earnings history going back decades. This is not a complicated government system. It is a straightforward list, year by year, the earnings that were officially recorded in your name. What you are looking for is simple. You are looking for years that show 0 when you know you worked. You are looking for years where the number seems significantly lower than what you remember earning. You are looking for gaps, especially around job changes, name changes, or periods of self-employment. If you find something that looks wrong, the Social Security Administration has a process for reviewing and correcting errors. You will need to gather supporting documents, old tax returns, W-2 forms, pay stubs, or employment records. The SSA takes these errors seriously because they know the stakes. Here is the important thing to understand. The longer you wait, the harder some of these corrections become. Older records require older documents. Employers go out of business. Records get lost. The window to catch and fix certain errors does not stay open forever. So if you have never looked at your earnings record, or if it has been several years since you checked, that changes today. But first, the earnings record is only the beginning of what we need to talk about. Because what comes next surprised even retirees who thought they had done everything right. Think back to the last time you named a beneficiary on a financial account. Maybe it was when you started a new job and your HR department handed you a stack of paperwork. Maybe it was when you opened an IRA or set up a pension. Maybe it was decades ago, before your children were adults, before you went through a divorce, before you remarried, before you lost a spouse. You signed a form, you handed it back, and then you never thought about it again. Here is what most retirees do not realize. Beneficiary designations are among the most powerful documents in your financial life, and they are completely separate from your will. If your will says one thing and your beneficiary form says something different, the beneficiary form wins. Always. Every time. The beneficiary designation on a retirement account, a life insurance policy, or a bank account overrides whatever your will says. This is not a gray area. It is established law. Which means if you named your first spouse as beneficiary on your IRA in 1989 and never updated it, even if you divorced, even if you remarried, even if that person passed away, that outdated form may still control what happens to your money. Financial planners see this situation far more often than most people realize. Someone passes away, their family assumes the money will go where the will directs it, and then they discover that an old form filed 25 years ago controls everything. What follows can be a legal tangle, a family conflict, or a genuinely heartbreaking outcome where the wrong person receives assets that were never intended for them. But there is a version of this problem that affects you while you are still alive, and it is the one we want to focus on today. When your beneficiary designation is outdated, incomplete, or incorrect, it can create complications in ways you might not expect. If you named a minor child without designating a proper trust or custodian, courts may need to get involved before any money can be distributed. If you left a section blank because you assumed you would fill it out later, there may be no valid designation at all, meaning your account could fall into probate, which delays everything, costs money, and removes the control you thought you had. And here is something that catches even financially careful retirees off guard. Many people update their will carefully. They sit with an attorney. They revise everything after a major life event. They feel organized and prepared. But they forget that beneficiary forms on individual accounts, retirement accounts, annuities, life insurance, even some bank accounts, exist completely outside the will. Each one needs to be updated separately. A missing signature, a partial name, an incorrect social security number, or a vague description like "my children" instead of specifically named individuals can all result in a designation that is legally void. When a designation is voided, the default rules of your retirement plan or financial institution take over, and those defaults rarely match your actual wishes. There is also a mistake that is less about paperwork and more about assumption. Some retirees believe that because their spouse automatically inherits everything, beneficiary forms do not matter. In community property states and in many pension structures, a spouse does have certain automatic rights, but this varies significantly by account type, by state law, and by the specific rules of the institution holding your money. Assuming protection exists without verifying it is one of the most expensive assumptions a retiree can make. The fix here is straightforward, but it requires action. You need to pull out every account you own, every retirement account, every IRA, every life insurance policy, every annuity, every bank or investment account with a transfer on death option, and verify exactly who is listed as beneficiary on each one. Not who you think you listed, not who you remember listing, who is actually on file right now. Then ask yourself, does this still reflect my wishes? Is this person still alive? Is this relationship still the same? Have there been divorces, deaths, estrangements, or new family members who should be included? If the answer to any of those questions raises even a small doubt, act on it. Updating a beneficiary designation usually takes less than 30 minutes. The financial and emotional cost of leaving an outdated form in place can be devastating. But outdated beneficiary forms and earnings record errors are still not the complete picture of what we need to cover today. Because there is a third category of overlooked detail, and this one is unique to people who have been collecting Social Security for a few years already. And it involves a decision you made that you probably cannot remember making. When Americans apply for Social Security, they are presented with a series of choices. Most people understand the big one, when to claim. But there are other decisions embedded in that application process that receive almost no attention, are rarely explained clearly, and in many cases are made in a rush because the applicant just wants to get the paperwork done. One of the most significant is the Medicare premium withholding structure, specifically the arrangement that connects your Medicare Part B premium to your Social Security benefit. When you enroll in Medicare and begin receiving Social Security, Medicare Part B premiums are typically deducted automatically from your monthly payment. Most people accept this without question. What fewer people understand is that the amount of your Part B premium is not fixed for everyone. It is income-based. Higher earners pay higher premiums under a system called IRMAA, the Income-Related Monthly Adjustment Amount. And here is where overlooked details become expensive. Your IRMAA surcharge is calculated based on your tax return from 2 years prior. If your income was unusually high in one specific year because you sold a property, took a large IRA distribution, or had a one-time capital gain, you may have been bumped into a higher Medicare premium tier. And if no one told you that you could appeal that determination based on a life-changing event, you may have spent a year or more paying hundreds of dollars more per month than necessary. Some retirees discover this years later and feel a profound frustration, not because the system was wrong, but because nobody explained that the option to appeal existed. But let us set Medicare aside for a moment and talk about a decision that has even longer-lasting consequences. When you applied for Social Security, you may have been asked whether you wanted to apply for spousal benefits, survivor benefits, or your own earned benefit. And the rules governing these choices are among the most misunderstood in all of retirement finance. For married couples, the claiming decision is not just about one person. It is a financial strategy that affects both partners, potentially for decades. The person with the lower benefit who claims early can lock in a permanently reduced spousal benefit. The person with the higher benefit who claims too soon reduces the survivor benefit their partner will receive if they pass away first. Here is what makes this so painful. Once you claim, the decision is largely permanent. There is a narrow 12-month window during which you can withdraw your application and repay benefits received, but outside that window, what you chose when you applied is what you live with. Most retirees did not sit with a financial advisor and map out a coordinated claiming strategy. They were told they could start collecting and they said yes. Divorced retirees face a separate but equally overlooked issue. If you were married for at least 10 years and are currently unmarried, you may be entitled to claim a benefit based on your former spouse's earnings record, potentially a higher benefit than your own. This is an established Social Security rule that a remarkable number of eligible retirees have never heard of, and therefore never pursued. And there is still another layer. If your spouse has passed away, survivor benefits follow entirely different rules than spousal or retirement benefits. Survivor benefits can be claimed as early as age 60. They can be claimed independently of your own retirement benefit, which means it is sometimes strategically advantageous to claim one early while allowing the other to grow. The coordination of these two benefits is something most surviving spouses navigate completely alone, without guidance, and often at significant financial cost. None of this is about blame. The Social Security system is genuinely complex. The rules have changed multiple times over the decades, and the agency itself, while it serves millions of Americans, is not in the business of volunteering information about strategies that might increase your benefit. You have to know what questions to ask. This is why the conversation you have with a financial advisor, with a knowledgeable family member, or sometimes even with an SSA representative who takes the time to explain your options, can be worth thousands of dollars. Not hundreds, thousands. In some cases, tens of thousands over the course of a retirement. And that brings us to the story I want to share with you. Because everything we have talked about so far, the earnings record, the beneficiary forms, the claiming decisions, it all comes together in one real person's experience. And when you hear what happened to her, you will understand why these overlooked details are not just financial inconveniences. They are the difference between a comfortable retirement and one defined by quiet financial stress that never should have existed. Dorothy was 71 years old, living just outside of Columbus, Ohio, when her daughter finally convinced her to sit down with a financial advisor for the first time. It had taken 2 years of gentle nudging. Dorothy was not the kind of person who liked to feel like she needed help. She had managed her own finances for decades. She had raised 3 children, worked full-time for most of her adult life, and navigated widowhood at 62 with more grace than most people could imagine. She was sharp, she was careful, and in her own mind she had everything handled. She had been collecting Social Security for 6 years. She had Medicare. She had a modest IRA she kept tucked away and almost never touched. She paid her bills on time and kept a small emergency cushion in her checking account. By most measures, she had done everything right. "I'm not rich," she told her daughter, "but I'm fine." Still, her daughter insisted, just once, just to make sure. The advisor, a woman named Karen who specialized in working with retirees already well into their 60s and 70s, started the meeting the same way she always did. She asked Dorothy 3 simple questions. Do you know what your Social Security benefit was based on when it was originally calculated? Who is currently listed as beneficiary on your IRA? And before you applied for Social Security, did anyone walk you through all of your options? Dorothy paused after each question. Then she said quietly that she was not really sure of any of the answers. They started with the earnings record. Dorothy had created a My Social Security account years earlier because her son had set it up for her, but she had never actually looked at the earnings history. It was just an account that existed somewhere. When Karen pulled it up and they began going through the numbers together, Dorothy leaned forward in her chair. 3 separate years in the early 1990s showed income figures that were drastically lower than anything Dorothy remembered earning. She had worked full-time during all 3 of those years at a manufacturing plant about 20 minutes from her home, a company that had since closed. One of those years, a year she remembered clearly because it was the year her youngest started kindergarten, showed 0 earnings. Not low earnings, 0. She had worked every single day that year. She had collected a paycheck every 2 weeks for 12 months straight, and somewhere across the decades that followed, through corporate record closings, Social Security system transitions, and the quiet passage of time, that entire year of her working life had simply vanished from her official record. Karen pulled up a benefit estimation tool and walked Dorothy through what that missing year likely meant in real numbers. Because Social Security calculates your benefit using your 35 highest earning years, a year that should have shown approximately $31,000 in wages had instead contributed a 0 to Dorothy's average. That single missing year, combined with the 2 years showing reduced figures, was almost certainly pulling her calculated benefit below what it should have been. Karen estimated the monthly impact somewhere between $60 and $85. Over the 6 years Dorothy had already been collecting, that uncorrected error had quietly cost her somewhere between $4,320 and $6,120 in benefits she had earned and never received. Dorothy sat very still. She looked at the screen for a long moment. Then she said in a voice that was more tired than angry, "Why did nobody ever tell me to check this?" Karen did not have a good answer, because there is not one. They were not finished. When they turned to the IRA beneficiary form, Dorothy was confident her daughter was listed. She had always intended for her daughter to receive that account. What was actually on file with the financial institution was the name of Dorothy's late husband, who had passed away 9 years earlier. There was no contingent beneficiary listed at all, no backup, no secondary name. If Dorothy had passed away before that form was updated, the account would have been directed to a deceased person, triggering a probate process that could have delayed distribution for months and consumed a meaningful portion of the account's value in legal and court fees. Updating the form took 20 minutes. Then Karen asked about the Social Security claiming decision. Dorothy had applied at 64, not the earliest possible age, not her full retirement age, but somewhere in between, because a friend had told her that 64 was a reasonable middle ground. She had not known that waiting just 2 additional years to her full retirement age would have increased her monthly payment by over $280. She had not been told about spousal benefit coordination options during the years her husband was still alive. Nobody had sat with her and mapped it out. She had made the best decision she could with the information she had. The problem was, she had not had enough information. Dorothy left Karen's office that afternoon with a correction request filed with the Social Security Administration, an updated beneficiary designation in place, and a clear picture of her finances for the first time in years. She could not recover every dollar that had quietly slipped away, but the bleeding stopped that day. And the question she asked, "Why did nobody tell me to check this?" is exactly the reason you are watching this video right now. Now that you understand what is at stake, let us get practical. This is not complicated, but it does require you to take action. Most people listen to information like this, feel concerned for a few minutes, and then go back to their normal routine. Do not be that person. Because the retirees who catch these mistakes are the ones who actually sat down and checked. Here are the 5 areas every retiree born before 1965 should review, ideally this week. The first is your Social Security earnings record. Go to ssa.gov and create or log into your My Social Security account. Pull up your full earnings history. Go through it year by year. You are looking for years that are missing, years that show significantly lower income than you remember, and years around job changes or name changes where errors are most common. If you find discrepancies, gather whatever documentation you can. Old tax returns are the most valuable, but W-2 forms, employer letters, and pay stubs also work. Contact the SSA at 1-800-772-1213 or visit your local SSA office to begin the correction process. Be patient. These reviews take time, but start now, because older records are harder to correct the longer you wait. The second is your beneficiary designations. Pull out a piece of paper and list every financial account you own, every IRA, every 401k or pension, every life insurance policy, every annuity, every bank account with a transfer on death designation. Then contact each institution and ask them to confirm who is currently listed as beneficiary, not who you think you listed, but who is actually on their official record right now. Verify that your named beneficiaries are still alive, still accurately named with correct Social Security numbers, and still the people you want to receive those assets. Update anything that is outdated, incomplete, or missing. If you have no contingent beneficiary listed, the person who inherits if your primary beneficiary passes before you, add one. The third is your Medicare premium tier. Log into Medicare.gov or call 1-800-MEDICARE and review your current Part B premium amount. If it is higher than the standard base premium, you are in an IRMAA tier, meaning your income 2 years ago placed you in a higher category. If your income has since decreased because of retirement, a one-time event, or any significant life change, you may be able to file an appeal using SSA Form SSA 44 to request a reduction based on changed circumstances. This is a legitimate process that many eligible retirees never pursue because they do not know it exists. Over the course of a year, this could mean hundreds of dollars back in your pocket. The fourth is your Social Security claiming strategy, or if you have not yet claimed, your plan going forward. If you are already collecting, review your original claiming decision. Did you understand all of your options at the time? If you are divorced and were married for 10 or more years, are you aware that you may be eligible for a benefit based on your former spouse's record? If you are widowed, do you understand how survivor benefits work and whether you are collecting the maximum you are entitled to? These are not just theoretical questions. They are real money, and getting a second opinion from a Social Security specialist or a fee-only retirement planner can pay for itself many times over. The fifth step is a simple annual review habit. Set a reminder, right now, before you watch anything else today, to review these 4 areas once a year. Pick a date you will remember: your birthday, tax season, the first of the year. It does not matter when. What matters is that you do it consistently, because retirement finances do not stay static. Life changes. Tax situations change. People named on old forms pass away or move on. Benefits get recalculated. New options become available. The retirees who protect their financial security are not the ones who knew more than everyone else. They are the ones who stayed engaged. They are the ones who asked questions. They are the ones who, like Dorothy, sat down with someone knowledgeable, even once, and said, "Can you help me make sure everything is actually right?" You have worked too hard and waited too long to let a forgotten form or a quiet error on an old record silently chip away at what you earned. The retirement you built over decades of early mornings, long shifts, and careful saving deserves to be protected with the same energy you used to build it. Here is the truth, and I want you to carry this with you when this video ends. The financial mistakes that hurt retirees the most are rarely the dramatic ones. They are not the market crashes or the big scams. They are the quiet ones. The form signed in 1991 that nobody updated. The earnings year that vanished from a record and nobody caught. The Social Security application completed in a hurry, without full information, that locked in a permanently lower payment. These are the $4,200 mistakes, the $20,000 mistakes. The mistakes that happen slowly, invisibly, over years, and only reveal themselves when someone finally decides to look. You decided to look today. That matters. Go to ssa.gov and check your earnings record this week. Pull out your account statements and verify your beneficiary designations. If you have a question about your Medicare premiums or your Social Security claiming strategy, pick up the phone or visit an advisor. One conversation can change the numbers for the rest of your life. If this video helped you today, please share it with someone you care about. A spouse, a sibling, a friend. They may be carrying one of these mistakes right now and have no idea. Thank you for watching. Take care of yourself and take care of your retirement.